really want to start with the dynamics we're seeing in the T-bill market. The T-bill market, of course, has attracted a lot of interest. We've seen huge liquidity in the market. And I think the key takeaway for me is that we're now beginning to see yields at below 10%. Talk to us through your thoughts on the results of the latest auction by the central bank.
Thank you, Wale. You're very right by saying there's been a lot of interest in the T-bills market. And going to the auction of yesterday, we saw a demand of over 500 billion naira at the auction, ranging from the 91 days to the 364 days yesterday.
Right.
It's not very surprising because a day before, we saw about 500 billion maturing into the system from the February 19, 2030 bond issuance. So there was so much liquidity in the system, and the necessary home for it for now would naturally be Treasury bills. So the good thing is that there is a blend of investors ranging from offshore to non-bank financial institutions and even individuals who are chasing the Treasury bills market at the moment.
Well, of course, when you consider that liquidity, we'll talk maybe a little more about that as we approach the MPC decision next month. But how much further can how much lower rather can yields go in your view, especially for Treasury bills? Because now I said they're now below 10%. Do you see them probably inching down to about 8%?
Well, I wouldn't be surprised if it inches further down. What it is now, the Treasury bill is trading as an asset class, and as long as there's liquidity in the market, it will continue to chase that. Remember, the offshore investors are also investing in our market. Among those countries in the JP Morgan index at the moment, Nigeria still offers the highest yield. Our exchange rates have been very stable. So with a stable exchange rate and with a high yield, even though it's in single digit, I think it's still attractive for these offshore investors to come, especially with Treasury bills being the short end of the curve. So you see that a lot of interest is coming into the short end right now, and that's because they are not playing duration at the moment. So at the single digit level, it's still, there's still attraction. The risk is not much because the duration is not very long. So you still see a lot of them playing on that part of the curve. And if you look at it, the last time T-bills rate were in single digit was September 2011.
Right.
Before then, you find out from 2006 to 2011, we had T-bills rate in single digit.
Yeah.
And it even went as low as 1%, 2%. And if you look at 2007, when the offshore investors were coming into the market, T-bills rate were in single digit. So it's about the yield they have to play, bearing country risk implication, and also looking at the stability of the currency. So will it be able to go below 8? It is very, very possible.
Okay, right. So of course, liquidity is something that the central bank needs to monitor very closely. And given the increased liquidity we've seen in the market these days, your thoughts on how they will be thinking about their decisions at the MPC next month? I want to get your early thoughts on this. Of course, it's still a few weeks ahead of us.
Well, most of the thinking from market operators now is, will central bank cut rates at the next MPC? It is possible, but again, if you look at it, the truth is, even though the central bank has left the MPR rate at 12%, they've kind of done some easing in the market. Look at where yields are at the moment. Even though they are mopping up at the OMO auction, I don't think their mop up is as aggressive because they are not doing it at any rate. There is a conscious move in bringing the rates down.
Right.
So there is a large disconnect from when the FPR rate is right now and where the current market yields are. So if you're looking at MPR, you probably say that the government is still embarking on a serious tightening policy. But I think you ask me, they've done a lot of easing, and you can see it from where yields are at the moment. So with a cut rate, it is very expected. Inflation is in single digit. People are looking at it, even if it's just for them to show good faith that, look, we are reducing rate for this real sector. I think they might just do it. But will it hold a match? I probably will not know.
Okay, final question. Very quickly, what about the CRR? Do you think the cash reserve ratio is something they could touch at the next MPC decision?
I doubt if the central bank will want to release a lot of liquidity into the market at the moment, considering where yields are. I don't see them touching the CRR at the moment.